All right, you guys, welcome to the Firefighters Financial Toolbox. What's going on Wednesday, episode 2. Appreciate you guys coming out. This is the second time we've tried this, so bear with me as I learn how this works. Looks like I've got a couple of my favorite commenters here. Northwest Firefighter Diver. Hey, how you doing? Good to see you. I'm glad you made it out. And Amico Uno, actually Amico 1, I'm glad you are here because you had one of the questions that I am going to answer today. And so that's pretty cool. All right, so first, without further ado, let's take a look at what the stock market's doing. And that leads us into Amico 1's question about last week. He asked me, what is a total stock market index? Which one do they use? And he told me that he uses VTSAX or VTI, and that actually uses the CRSP total stock market index. So if we go to my page share here, we have this. Actually, let's make that bigger. We have this up, and we're going to bring this one all the way to the front of the screen, you guys. So forgive me for a second. So what the CRSP index is actually is it stands for the Center for Research and Security Prices, and it's based out of the Chicago Business School. And it's just an index that Vanguard has chosen to use. There are several different indexes, you guys, out there. Other indexes include the Wilshire 500, or correction, the Wilshire 5000, the Russell 3000, and of course, when we're talking about the CRSP. So if we go back and we take a look at how this thing's done, let's take a look at the last week first. Now, you know that we started out the week a little bit slow. And it looks like in this particular index, they started at about 2359. And currently, which I believe the markets are now closed, and it looks like it's up to about 2470. So we're talking about an increase of about 100 points in this particular index, you guys. Now remember, and all indexes are a little bit different now. They follow. So if we scroll up and we look at the 5-day here, let's take a look at the ones most people know better. Let's look at the 5-day in the Dow. We can see sort of an upward trend. If we look at the S&P 500, again, it looks very similar. The numbers are a little different because, oops. Now we went back to the 1-day. Let's go back to the 5-day. Okay. There we are. So if we look at the S&P 500, you see that went up. If we look at the NASDAQ, similar trajectory lines for all of them, you guys. And obviously the valuation numbers are different depending on the index. So if we come back to it, we can understand that depending on what index you're following, that's going to affect and change what the numbers are and what they look like to you. So Amico 1, in answer to your question, the CRSP total stock market index is the index used by Vanguard. And so as you can see, that's the market it follows, because as you know, they pay for an index, and when they pay the index, that's the one they get to use. All right, so today the topic that we're going to talk about overall, you guys, and if you have questions or comments, please put them in the comments and I'll try to get to you as I can. Today we're going to talk about, will the stock market crash again in 2020? Excuse me, in 2020. And the first, and I have 3 reasons I think it's going to. Reason number 1 is what they call the October effect. And you guys, the October effect is basically, October is not a good month in the stock market. If we take a look at the screen here, and I'm going to make this full screen so we can kind of follow along a little easier. All right, so we're looking at the screen here, and the headline, October, the month of market crashes. We scroll down. October is a unique month, and October is a transitional month and has a special and it's had several cases where it has had what they call the October effect. Going back to 1907, and they had what they called the bank panic of 1907. There was a financial panic in the markets. It started in October of 1907, and it stretched out for about 6 weeks. Now, J.P. Morgan actually led a consortium that sort of helped it from causing a serious crash. Now, that was before the Federal Reserve was in existence, and so it kind of did the job of what the Federal Reserve would do nowadays. And then, of course, everybody knows about the stock market crash of 1929. Again, that happened on October 24th of 1929. They called it Black Thursday. And of course, we know what happened. We slid into a depression that lasted for almost a decade. Fast forward to the 80s, you guys, 1987. This is when I was in basic training. Black Monday, the biggest single day drop of the stock market ever. In fact, the Dow dropped a total of 22% over just a few hours, you guys. And this is when they actually instituted what was called a stop loss order because it was so bad. All right, so taking blame. Oddly enough, September, not October, has more historical down markets. And this year is no exception, you guys. We've had a pretty gloom September so far. And that's just one of the reasons I think there may be a problem. Second one I'm talking about is for a different reason. Now, you guys know I'm not allowed to say this name because I don't want to be demonetized after I finally just got it. So we're going to use a misnomer for it. And we're going to talk about the coronavirus. All right, so I apologize, my pages are low. So in case you guys haven't heard, Europe is having a second wave, and actually in some cases a bigger wave in the coronavirus, and it coming back as a problem. In some countries, it's actually Albania, Bulgaria, Czech Republic, a few of the other companies are actually having higher numbers than they have had yet. An example, in France, they declared over 16,000 new cases on Thursday, and that was one of the highest days they'd ever recorded. If we take a look at some of these different countries, so here we are looking at Croatia. You can see that back in March, they had a little spike, but this spike currently is even bigger. In the Czech Republic, they had a pretty easy one the first go around, but this time it's pretty substantial. Italy, where it started, where my wife is from. Of course, you know, Italy was the first European country to really have a big problem. Now, they've had a little bit of an uptick, but not nearly as bad as some of the other countries. Small countries like Luxembourg have done pretty well. If we look at Belgium, for example, Belgium is having a second strong wave like they did the first time. Over in England, same thing. We had a pretty good uptick back in March and April, and it's really starting to creep up again here in September. What does that mean for us? You guys, I don't know for sure what that means, but one thing I do know, the markets get the markets get volatile when there is uncertainty. And we've already talked about the uncertainty of the October effect. We know that history has shown us quite often October can be a dark month in the stock market. We also know that the Rona is starting to come back. And when that happens, there could be lockdowns. There could be other things happening. Now, I don't know that they will, but they could. And these are things that make the market unsteady. The third thing that we got to talk about out here about this is real easy, you guys, and that is presidential elections. Now, you guys know, and I don't want to get into politics at all because That's not what we do on this channel. But we all know, let's take a look here again. This keeps moving. How the presidential elections affect the stock market. Now, myths abound, but when it comes to your portfolio, it doesn't matter much which party wins the White House. Now, I'm sure a lot of people would disagree with this in the fact that obviously the way the two parties tax is completely different. But here, let's see what it says. Every 4 years, politics and finance converge as the Americans elect a president, and investors try to figure out what the outcome is going to mean for their portfolios. Excuse me. A look back at history shows that presidential election cycles indeed do correlate with stock market returns, although not always in the same way. The mood pulls on the tides. As for the outcome of elections, the impacts might surprise you. Okay. No one needs to tell you that the current cycle is anything but average. The Dow racked up an impressive 27% in the first year of President Obama's second term and 7.5% in year two. So, Democrat or Republican, you may feel strongly about one party or the other when it comes to your politics, but when it comes to your portfolio, it doesn't matter which party wins the White House. Conventional wisdom might suggest Republicans, who are supposedly more business-friendly than Democrats, would be more beneficial for your holdings. In fact, looking back to 1900, Democrats have been slightly better for stocks than compared with Republican administrations. Again, I'm not going to say one way or the other that it's going to affect that, but we all know as the turmoil and craziness of the election gets started, you guys, things go crazy in the markets. And when the markets get uneasy, they get volatile. And there are a lot of people that are out there saying, hey, I need to sell my stocks, go to cash. I don't know. Yes, we're going to have some bouncy roads for sure with the coming trends. But I think if you're like I am and you're a long-term investor, you guys, I think the best thing is just hold on to your stocks. Don't make any brash decisions over short-term things. We can't do anything about October being the October effect and the traditional effect that it's had on the market. Can't do anything about that. October is the 10th month, no matter what we do. With the Rona coming back, obviously that could be a big impact on financial markets and particularly global financial markets. But again, we got through the first one. I think we'll get through the second one. Third one is the election. You guys, the election is going to happen on the first Tuesday of November, and the results are going to be what they are. Again, I don't want to get into politics because that's not what I talk about on this channel, but it's going to happen, and it may very well affect the markets in the short term. It may affect them for months after the election. I don't really know. But I know that I have at least 30 years of life left, hopefully. And so my portfolio is going to have to last me into my retirement. And hopefully I'll have something to leave for my son when I pass. So I'm not changing anything I'm doing. What about you guys? I haven't heard too many from my commenters since the beginning. Excuse me. What are you guys doing? How's the election affecting you? How is it going to affect what you do? Let me know in the comments. You give me a comment, it gives me something to talk about. Have any of you changed your have you changed how your portfolio is set up? Have you changed your philosophies because of what's going on? Have you been affected by the Rona? I know personally, my wife used to have a nice office. Now she has a home office because when they sent her to work from home, it stuck, and they decided that she could work from home forever. And so far, it seems to be the case. Ash, I'm keeping everything the same. I haven't changed my investment policy. I agree with you, Ash. I think that's the best thing you can do. I think no matter what happens, if you have, first of all, everybody should have an investment priority statement. I feel like you should write down what your investments are, your long-term goals, your short-term goals, if you have those, right? For example, if you're buying a house in 5 years, or you're paying for a wedding or anything else, short-term goals, obviously, you're going to invest those completely different. But for your retirement investment and your long-term goals, you guys, I think you should write down so that when times get tough, and let's face it, we went through a little scare back in March. I don't know about you, but I watched my portfolio drop about 35% at one point. And to say it wasn't scary would be a lie. It was definitely a little bit frightening for me. But I have a written statement that says I'm going to be this percentage of stocks, this percentage of bonds. I'm going to buy dips. I'm going to keep buying all the time. And that's the policy that I live by, and it's the policy that I plan to keep for as long as I keep investing. And even when I get into retirement, hopefully in about 4 years, I will be able to still invest the money that and some of the money that I'm taking out that I don't need to use, because we personally live pretty frugally, and it makes it a little bit easier for us to do that. Right now, we save somewhere about 30 to 35% of our income, but we had to play catch up because I made some really bad mistakes when I first started, and I'm paying for that now. Anyway, if you guys have any other comments, let's talk about them really quickly. Otherwise, I'm going to try to keep this to about 20 minutes because anything longer than that on the replay doesn't really last very well and people don't stick around. Again, Amico1, thank you for your question about the CRSP index. I hope that answered it, and I hope that you can do that. Oh, here's another question. Ash K says, how many years in cash do you plan to have when you retire? That's a really good question, Ashley. I'm sorry, Ash. I'm assuming your name is Ashley. Ash, in answer to you, I want to have at least 3 years in cash of all my living expenses, because that way, historically, most recessions, now obviously all we can do is base it on history, and we don't know that means that's what's going to happen in the future. But historically, within 18 months, the market usually corrects enough that you're not down. And so I figure if I have 3 years of expenses, that's this year, and 2 more years to allow the market to correct, I should be okay. Now, I believe in the 3 bucket strategy. So first bucket is 3 to 4 years in cash, and everybody can change this how they like it, but at least 2 to 3 years in cash, and then a middle bucket that might have some dividend stocks, some bonds if you choose to hold those, something that's going to get you in about 3 years, 3 to 7, somewhere in there. That way you can leave the 7 year on. The third bucket is all stocks, all long-term growth stocks. That's going to be the money that's going to keep you going in retirement. And what you can do is, if you have a super good year in the stock market where you get 20% returns, maybe you take a little bit of money out of that bucket and refill your cash bucket. If not, then you can move it from there to your middle bucket, from your middle bucket down to your cash bucket. But that's a really good question. And again, it's very individual. Personally, we know that cash is worthless right now. We can't get any money. But I also believe in security. And I think the reason people hold bonds is for security. And I think having that 3 years in cash to make sure I know I don't have to worry about what the stock market does tomorrow or next week gives me a sense of security that I'm doing all right. All right, well, we're right at the 20 mark. And so you guys, I'm going to cut this one off. I appreciate everybody coming out. If you like this, do me a favor, give me a thumbs up. Tell your friends, don't be afraid to share if you got something out of this. I'm going to try to make this a weekly occurrence where if somebody gives me a topic, I'm going to use it as a topic to talk about on Wednesdays. So I hope you enjoyed this. If you did, as I said, if you're not already subscribed, you guys, I'm going to do the plug. Go ahead and subscribe. Hit the button, ring the bell. You'll find out every time I make a new video. All right. Thanks a lot. Have a good day.